Ashwini daughter Rameshwara would like to present about liquidity ratio. This ratio means the ability of a business to meet its currency. Current ratio is current assets over current liability. For example, current assets is 15,000. However, current liability is 7,500. So the current ratio will be 2.1. Next will be acid test or quick ratio. A better measurement of liquidity than current ratio because doesn't take into account the inventory of the business, which is the less liquid assets of the current assets. The prepayment are deducted because they are considered to be less liquid and generally will not convert into cash. The formula of this asset test or quick ratio is current assets equals to minus inventory minus prepay over current liabilities. Effective ratio, inventory turnover ratio. This ratio measures the efficiency of the business managing its assets to generate revenue. The formula is cost of goods sold over average inventory. Average inventory equals to 1 over 2 bracket opening inventory plus closing inventory. The use of ratio to analyze the financial statement is assets turnover ratio. Assets turnover ratio is net sale over average total assets. Net sale found on the income statement are used to calculate this ratio. Turn and refund must be backed out of total sales to measure the truly measurement the firm's assets ability to generate sales. Average total assets are usually calculated by adding the beginning and the ending total assets balance together and dividing by 2. This is a simple average based on 2 years balance sheet. A more in-depth weighted average calculation can be used, but it's not necessary. Is debitor turnover ratio. The formula of debitor turnover ratio is credit sale over average debtor. This will give you the number of times per year the debits will turn over. Average equals to opening debtor balance plus closing balance over 2. Thank you.
Hi, I'm Gauri. Today I'm going to present about average collection period. What is average collection period? Average collection period is an average number of a day between number 1, the date that a credit sale is made, and number 2, the date that the money is received from the customer. It represents the length of time a business undertakes to collect money from its debtor or account receivable. The formula of average collection period is accounts receivable divided by credit sale and times with 365. Okay. Number 2 is what is profitability ratio. This ratio measures the performance of business during an accounting period. Into the profitability ratio, got gross profit margin. Gross profit margin is a profitability ratio that measures how much of every dollar of revenue is left over after paying cost of goods sold. Gross margin ratio is the ratio of gross profit of a business to its revenue. It is a profitability ratio measuring what proportion of revenue is converted into gross profit. Gross profit and revenues figure are obtained about the income statement of business. The formula of gross profit margin is by dividing gross profit and sales times with 100. Third, net. And now return on asset ratio. This ratio can also be represented as a product of the profit margin and the total asset turnover. Either formula can be used to calculate the return on the total asset. When using the first formula, add the beginning and the ending asset together on the balance sheet and divided by 2 of average total asset is the historical cost of the asset on the balance sheet without taking into consideration the accumulated depreciation. The net income can be found on the income statement. Return on asset ratio divided into net income and average total assets. And lastly, return on equity ratio. Return on equity ratio is a profitability ratio that measures the ability of a firm to generate profit from its shareholder investment in the company. In other words, the return on the equity ratio shows how much profit each dollar of common stockholder equity generates. ROE is also indicate how effective management at using equity financial to fund operation and grow the company. The return on equity ratio formula is calculated by dividing net income by shareholders' equities. Thank you.